Aaron and Mike, welcome to the Halftime Report. I am Frank Holland in for Scott Wapner. Front and center at this hour, the big bounce following Friday's sell-off. We're going to tell you how the committee is playing it. Joining me for the hour, we have Joe Terranova, Jenny Harrington, Steve Weiss, and Jim Lebenthal. First, quick check on the markets right now. You can see green all across the board again after the big sell-off on Friday. Each one of the indices regaining about 75% or so of what they lost on Friday. Right now, we're seeing the S&P up about 1.5%. The NASDAQ doing better than 2%. Taking a lot of the tariff talk very seriously. By the way, Ed Yardeni also putting out a note today saying if neither side were to blink, the U.S. and Chinese economies would lead the global economy into a deep recession, if not a depression. But he expects both sides to blink relatively soon. Steve Weiss, what's soon? Does soon have to happen before President Xi and President Trump meet? And what does that mean for the markets if we don't see a quote-unquote blink before that?
Well, I can't answer what's soon, but I can tell you that the market assumes soon has already come and passed, given the bounce back from Friday. So, look, the market, what was surprising was the reaction on Friday. And I think that wasn't the reaction as much to the China, another tantrum on tariffs with China from the president. I think that was the reaction to the sensitivity to where the market is, all the bubble talk, not just in AI, but in the market, and the fact that it's trading without the support of valuation and fundamentals, it's trading on momentum. So that was a momentum killer. So, look, I do think it'll work out because this must have scared the president, right? And on the weekend that he's doing something good with the, with freeing the hostages and trying to create peace in the Middle East, this sort of took the headlines, what it shouldn't have. So I think all that's an issue. And frankly, to me, it just points out that this market is in a, I don't want to say perilous position, but it is in a tentative position where, to Jenny's point, we never really know what the catalyst is to take it down. And for me, the intermediate term still seems to be positive because the market's willing to forget and forgive overnight these reactions. So I remain pretty much fully invested in the market, and I still think the AI, the permanent compounders, will win out. But I am troubled by stocks that I own, like Caterpillar, having the move that it's had, since I bought it. So there are definitely cautious signs here, but I don't know if there's anything to do about it. Nobody should be willing to, or few would be willing to sell their positions and pay taxes, right? Even capital gains tax at this level. And then FOMO just continues to drive it.
All right, Jimmy, coming over to you. S&P up about 1.5%, NASDAQ up about 2%. Is this just forgive and forget? Let's not worry about that. The president, in all fairness, made some comments. He posted on Truth Social. We also heard from Chinese officials saying they don't want to fight. They're ready to fight, but actually don't want to fight. And there's also a lot of thought that this may just be posturing ahead of that meeting between Xi and Trump. The idea of restricting rare earths and also some of the tech export restrictions, specifically on NVIDIA chips. They made a lot of headlines next week. So is this simply forgive and forget, or did we get some reasons maybe for the markets to rally the way they are right now?
Well, I think what you're seeing here is negotiations as it comes to trade and tariffs. And you know what? That will be resolved one way or the other in the coming weeks. So will the shutdown. It will be resolved one way or the other in the coming weeks. And I can't tell you exactly when, but I will tell you what troubles me and what I think troubled the market far more on Friday than the actual tariff announcement from the president is what Joe was alluding to. Joe, you started this off talking about leverage, and I agree. I think there are some serious concerns in terms of leverage. I say serious. We can resolve these, but we need to keep our eye on them. Tricolor and First Brands, clearly there was some poor underwriting standards by Jefferies, by First Third, and with this Point Bonita fund, which apparently had 25% of its investments in First Brands receivables, that's poor risk control. Now, these are things that if they're one-offs, fine, no big deal. But you know what? In May of 2007, or June of 2007, that's what people said about Bear Stearns with the mortgage-backed hedge funds. I'm not saying it's a direct comparable. History doesn't repeat itself. It does rhyme. What I am saying is let's start paying attention to credit spreads. They've been incredibly tight. They've been incredibly benign. And Jenny, to your comment, your rhetorical question about, I think you phrased it this way, why are we selling off so much 3% on Friday? I think it had, look, the tariff announcement was the match. The kindling, the fuel was what was going on in crypto. Not talking about about Bitcoin, not talking about Ethereum. I'm talking about altcoins, many of which got absolutely wiped out. There are reports that 1.6 million accounts got liquidated by automatic delevering algorithms at trading platforms. That's, leverage is what could upset this. That's what traditionally does upset a bull market. So let's keep an eye on the leverage ratios.
I think Jimmy's spot on. It's a story for 2026, but I just want to come at this from the perspective of, is there anything that you should be doing based on the price action Friday, based on the price action today in your portfolio? I think from the element of, okay, the market has recovered. Well, yeah, it's recovered. We only have 3 new 52-week highs today in the S&P, Martin Marietta, CVS, and Cencora. I think the last 2 days, though, has really illuminated what is going on in the precious metals market. And I think a lot of people that don't have precious metals exposure is saying, okay, look at silver, which is going back towards the Hunt Brothers high at 1980. Look at gold, which was strong on Friday, strong again today at 4,100. They're looking at that and saying, okay, maybe it's time to increase my exposure to the precious metals. I think that's the one portfolio message that stands out over the last 2 days. And I'll tell you, Bitcoin, it wasn't the diversifier that I was told it was going to be in a highly volatile environment.
There are structural issues there. I can theoretically get my arms around why it would be a hedge against fiat currency, but until you resolve these structural issues on the trading platforms about these perpetual futures and how they unwind not just the losers, but the winning trades as well in order to maintain liquidity on the platform, which has the effect of totally upsetting anybody who's got a balanced book in terms of crypto. Those things need to be resolved before we can talk about this being a hedge.
But that's the negative effect of 24/7 trading. And
I'm with you, brother.
For those that want 24/7, understand you're not going to see the liquidity in the early hours on a Saturday morning like ultimately you're going to see in the early hours on a Tuesday morning.
Let's talk about what Joe asked, which is, what do you do? How do you, what do you do in this environment where we're all saying there's something brewing, there's something a little uncomfortable out there? One of the things that really bothers me is in times like early April, we start on this desk getting the question, should you be repositioning your portfolio? Should you have more bonds because the market's down? No, the time to start asking that question is right now, when you just got that reminder that there's fragility out there, whether it's leverage, whether it's response to the tweet, whether the tariff, whether it's response to Bitcoin, whatever is out there, there's something out there. So you want to think now, while the market's still almost at its all-time high, you want to think about how you want to reposition now. And what I like doing, because it's super hard to say, hey, just sell your NVIDIA, trim your Microsoft, trim your Apple now. Look if it's in your IRA. If it's in your IRA and you don't have a huge capital gain, think about taking a little bit off and think about maybe repositioning into fixed income, into areas that haven't done as well, into a more diversified portfolio. But the time to have that conversation preemptively is today,
all right,
not in a couple months.
Today's the time to have it. And Jimmy, you're mentioning leverage, issues with liquidity. We saw liquidity, people liquidate their crypto positions, looking to get some money to cover some of their losses. So what's the answer for an equity investor right now? You're shaking your head and smirking a little bit.
There's one always true answer, which is invest in high quality companies. If the market goes down, it's the highest quality, the biggest companies in any industry that are not only going to survive through a downturn, but thrive on the other side. But perhaps more pertinent to the discussion we're having is that we've got bank earnings coming up tomorrow and on Wednesday, and they are important because the banks have been a little heavy the past few weeks. The publicly traded business development corporations have been more than a little heavy. The alt managers, the private credit companies have been kind of heavy as well. So we need to see some indications, some commentary from the likes of Jane Fraser, Jamie Dimon, et cetera, that the corporate balance sheets and retail balance sheets are just fine. It couldn't come at a better time.
Well, yeah, I think you have to disassociate the banks from BDCs and private credit firms, okay, because they're completely different dynamics there. What we're looking for from the banks and what we'll get from the banks are, of course, loan loss reserves, are they increasing them? But those are more from regular way businesses and regular way consumers, and then absolutely deal flow. Now, the fact they've been in pressure for 2 weeks after being in a leader position or more, after being in a leader position for 2 years, and I would hardly call it pressure, is insignificant and just doesn't matter. However, the others do have some issues, and we've seen that recently with First Brands and a subprime lender. However, I just don't think it's enough at this point to derail the market. Spreads just really haven't widened enough or at all to say there's lots of risk there.
But I want to ask you a question. I want to go back to Jimmy's point. We are going to hear from the banks. So if the banks start to get nervous, or they signal they're going to get nervous, doesn't that hit sentiment? If you look back at 2008, and I was actually speaking to John Sinek from Metric Capital, who worked at UBS during the financial crisis, he said really the issue here is sentiment and confidence. And if you have a levered fund and the banks want their money back, that can create a run on confidence more broadly.
I don't think that's where we are. Hang on, he asked me, so I'm going to answer it. And Steve, your point is well made that there's far more to banks right now than just credit quality. There's a lot to say about deal making, IPOs, et cetera. But the point that I'm driving at is that this is a point in time where we want more information. Yes, credit spreads have been very tight, and they have started to pick up a little bit. My point is these are things to keep an eye on. So I will be paying close attention to what the commentary is about credit worthiness. And remember, we're at a time where we're at a lack of macroeconomic indication. Yes, there are some private market substitutes, but still, this is a time where I, as an investor, want information, and the bank reports couldn't come at a better time. I'm not crying fire in a crowded theater. Look, it's not what I'm doing. I'm simply saying this is a time to pay attention
that's
to
what I'm
these
asking.
things.
You're saying if we hear some positively questionable sentiment from the banks, that could raise even deeper questions about credit.
Yes.
Well, but that's the other side of the argument you were making. They can make us more confident, or they could actually reduce confidence with some of their comments.
Frank, your question, no offense, is entirely misplaced. When have the banks
No
ever?
offense.
No offense.
When have the banks ever come out? When has Jamie Dimon ever come out and say, "I'm worried about," in a way that shows worry, as opposed to an observation, consumers slowing down, this and that? It's just not going to happen.
But we read the tea leaves in every
world.
comment the money center banks make, in all fairness, Weiss, to you. And your comment, I'm not saying it's misplaced, but don't we read the tea leaves? And as you just mentioned, bank earnings, or as Jimmy mentioned, I should say, very important, going to be very closely watched about strength of the economy, strength of the consumer, and also credit after this First Brands issue. In fact, we saw the Jefferies CEO issue a letter just to try to reassure people.
Well, he should have, because they're just right. They're First Brands. They have exposure. Of course, he's got to. The stock went into a free fall because of their exposure there. But my point is, we'll hear what we hear from the banks all the time. People there, whether it's Moynihan or Solomon or Jamie Dimon, or pick anybody that come out, they're highly confident in their business models. They're highly confident in their risk management. They may take shots, subdued shots in other areas of the credit industry, but I think it's going to be fine. But they're not going to, because they're building big businesses in private credit.
Come at it from the perspective of positioning, though. Think of it this way. Steve, I like what you said when you talk about the financials. First of all, to Jimmy's point on quality, here's the challenge. Jenny, you know this. Quality hasn't worked in 2025. And guess what today? Quality's not working as well. No, it's not personal to your portfolio. Quality's not bouncing back today. Momentum's bouncing back today. If you look at the quality factor year to date, everyone says own quality. The quality factor's underperforming.
Those titles are misnomers, though.
But that's just the reality of the statistics. It doesn't mean glimpse into the future. Jimmy's not correct. You pivot towards quality because of the environment. But think about positioning in financials, because I really believe this quarter is a reckoning moment for financials. I'll tell you why. BDCs, I'm sorry, I wouldn't touch them right now. Wouldn't touch.
Would you ever touch them, though?
Probably in maybe in an 09 environment, maybe in a March of 2020 environment. Private equity is not trading well. We talked about this the other day on the show. For whatever the reasons are you want to cite for the publicly traded private equity companies, they're not trading well. All right, but now let's go to the money center banks. Steve's right. The money center banks, the biggest question is going to be, what are you going to do with the excess capital?
Exactly.
Are you going to increase your buyback? Because there's going to be significant increased capital. So the market already knows that there's a really feel-good story. Tomorrow we get JP Morgan, we get Goldman Sachs. The market knows there's a feel-good story. But say to yourself, okay, what's the reaction to that? Because everyone who's long, myself included, most people are long JP Morgan. Most people are long Goldman Sachs. They're not carrying it at an underweight. Focus on what the reaction is going to be. Are you going to hear good news and then have a bad price reaction to that? That's the reckoning moment. That's where you begin to get troubled. Or can you have what you've had in prior quarters, which is good news, and follow through good price action?
All right. Can I say one more thing on this, because I think it's really important? So as we're thinking about the banks and the BDCs, which we never talk about BDCs here, and I think it's important, as we go through this quarter, this is going to be incredibly insightful. And I think to some degree, what we hear from the banks in the coming week is not going to be that telling, because the banks and who they're lending to, those are the creme de la creme. And we all know out there that there is a huge bifurcation in the top end of the consumer, and that they're still healthy, and in the lower end of the consumer, and that we're starting to see cracks lower end of the consumer. Auto loan bankruptcies are like the highest they've been in 9 years. These numbers at the lower end are really starting to show up. And I think if we listen carefully, it doesn't matter so much what the big banks say, but what is going to matter is what the BDCs say. Because who they lend to is a much broader, bigger swath of America, is much more reflective of the overall economy and the overall environment out there. So I think if you want to know what's really going on, you listen to Ares, you listen to Golub, you listen to Sixth Street. The one thing that I'd say is, I don't think all BDCs are created equal. So we own 2 in our portfolio that I'm very comfortable investing in.
And which names are those?
Those are Sixth Street Lending and Hercules Technology. The rest, Joe, I'm completely on board with. And Barron's had a big article this weekend basically saying, like, hey, look at these BDCs. A whole bunch of them, I think there's like 10 on their list, are trading at a discount to NAV. I was emailing with a client this morning. I said it misses a nuance. It misses the nuance that just because a BDC is under NAV, like, that's actually not a great buy signal. It's not a great metric for valuation, so you don't really want to listen to that. But what we all want to listen to as armchair economists, we want to listen to what the BDCs are saying about the credit of their underlying portfolios. That's going to be more interesting than what JP Morgan said.
Frank, I don't mind being early to say this, but all I'm saying is watch out. Just pay attention, because a lot of things that have propped up this market just showed some cracks, and not good ones. We're talking about crypto. Joe, how many times have you and I before the show talked about zero time to expiration options and how that's propping up a certain name? The answer is a lot, okay? There is. And Steve, how many times, I don't think I'm misquoting you, how many times have you and I talked about a gambler's mentality in this market? In fact, over many years. That's a chicken that's going to come home to roost at some point in time. I'm more in agreement with you than disagreement, Joe, that this does get through into 2026, that it's a 2026 problem. But the simple truth of the matter is, I'm an old man. I've been through a few things.
You're not that old,
I remember
Jimmy.
Bear Stearns. I remember the fact that the banks topped out in May of 2007. And, I don't like the decline we've seen in some of these banks. Citigroup's off about 8% from a recent high, just as an example. And I hope it's nothing.
Yeah.
I hope that tomorrow and Wednesday, everybody's saying, look, Leventhal was worried about nothing. Believe me. That's what I hope. I'm still watching.
Look at the last quarter, though, the performance of the various equity indices, and know that a lot of these money center banks are going to deliver historic equity-related revenue.
I want to continue the conversation that we're having about commodities. Jimmy, I'm going to come over to you. You made a face when he was talking about just the gold right now.
Well, look,
the rally we're seeing there.
Gold's had a heck of a rally. It is certainly, at least in part, based on concerns about the decline in the dollar, the concerns about inflation, whether they're tariff-related or otherwise. That's understandable. But it does feel like we're entering the melt-up phase, pun intended, in the gold rally, where the fundamentals are baked in. This is more the FOMO going on, the momentum going on. It may be spilling over as well, Joe, into silver. There are reasons, and I just listed them, to perhaps own gold, but I don't think this is the time in which you want to dive in, given what phase I think we're in.
All right, I'm jumped the gun there a bit. We've got some more calls. AstraZeneca reaching a deal with the Trump administration to lower drug prices. Jim, you own AstraZeneca as well.
Well, AstraZeneca is one of the companies that have played along in terms of the president's policies. They've announced a number of deals to invest in factories here in the U.S. Certainly, Pfizer has set the standard of how you basically kiss the ring finger and move forward, and AstraZeneca is doing the same thing. Even regardless of that, it's a very attractively priced company with a broad array of portfolio pipeline in all sorts of therapeutic areas, good dividend yield. So regardless of whether they're playing the game or not, it's an attractive company.
All right, want to go on to PayPal, actually downgraded to sell by Goldman Sachs. Joe T., you own this one.
Yeah, so this has been disappointing. Full disclosure, we entered the ETF PayPal at the end of July. 68.76, I think, is the entry price, so it's literally a break even. There's challenges here. Look, the bulls will say the potential for a larger buyback is there, the ability to monetize Venmo, potentially is there. Maybe a deal similar to what they did in 2013 with Braintree for $800 million, which got them Venmo. But in reality, the price performance has not been there. They have not been able to really ignite the revenue growth. We'll see what we do with the position at the end of the month.
All right, I want to go to the gaming space. We had our contested brew over in Macau last week. Casinos, however, getting hit hard today. Jeffrey says Macau gross gaming revenue through the Golden Week was actually below expectations. Jim, coming over to you. You own Wynn.
I do own Wynn. I trimmed it at 126. It's currently at 115. I would like to add it back, so I'm enjoying this little dip here. However, look, I think this is a direct beneficiary or victim of the tariff wars picking up again with regards to China. I think it's that simple. If you're looking at Wynn as a long-term investment, and I do still hold a position, you're thinking about the year ahead. You're thinking about the Al Marjan Resort to open up in early 2027 in Dubai. You're thinking about Las Vegas recovering on a strong economy. The sell-off recently, I did think it was overpriced. That's why I trimmed it. And I really think this is just tariff related.
All right, I want to go to MedTech very quickly, something that could be impacted if tariffs are increased. We got BTIG upgrading Zimmer Biomet Holdings, raising the price target from 118 up to 122. Also a buy rating saying the shares have given up some gains that they saw last quarter, yet its FX composition is the easiest of the year, coupled with new product cycles and a strong July. I want to come over to this one. Jenny, you also own this one, Zimmer Biomet Holdings.
Yeah, and couple all that with 11 times earnings and 8% free cash flow yield and decent little kind of like mid to high single digit earnings growth ahead. What they do is they do hips and knees. It has been a complete bummer for pretty much 10 years, but at some point they have really great products and everything's got a price. And 11 times with that much free cash flow generation says to us this is probably a good place to be. When we were talking about being nervous about the market before, nervous about valuations, this is kind of a nice place to hide out.
You know, I think one thing the market loses sight of, and as we do in companies like this which appear cheap, is that healthcare, we always talk about it being broken. Well, it's more broken than it's ever been. And as a result, hospitals aren't making money. And some practices are significantly strained as well. So when you take a situation like Memorial Sloan Kettering, where they lose $150 million in funding, and you go through Harvard, you go through all the others, and the hospitals, the funding of New Jersey, I don't think there's a hospital in New Jersey making money, big hospital systems. So naturally, like any other buyer of products, their appetite is going to wane for new products, more expensive products. So unless they can show that they're more productive and they're cheaper than what they currently have, the roadblocks that have been put up are going to be somewhat insurmountable. It used to be that doctors, the head surgeons, dictated what equipment, what devices were bought by the hospitals. They're out of the loop. Now it's the administrators, and the administrators are told to focus on the bottom line. So I think that's going to be sort of like, a barrier to these stocks doing well.
Now let's hit our chart of the day. It's Broadcom surging after announcing a partnership with OpenAI. Joe, you own Broadcom, shares up over 10%.
It's been one of the better performers for us in the ETF. Look, this is the competitive nature of what we see going on right now with the semiconductor industry. We saw it with Lisa Su, AMD, everyone trying to kind of compete with the positioning that NVIDIA has, which appears to be front and center. The question on this, and this is a question for all of us to kind of curate over the coming months, is there's a lot of capital that is going to be needed here by OpenAI. Not specific details exactly how this is going to be ultimately funded, but it is somewhat perplexing to me that we are becoming more and more reliant on this one private company's ability to keep spending, building out the technology infrastructure.
To your point, a piece in the journal is saying OpenAI's revenues this year about $13 billion. It's going to take hundreds of billions of dollars to really pay for all these different deals. So they would have to have a massive escalation in revenue just to pay for all these different deals. But even Broadcom deal, all the other deals out there. Jenny, I know you had a thought about this as well.
I have two thoughts. When we talk about it, I think we're at over $1 trillion of deals or partnerships signed right now. And when I think about the fact that NVIDIA alone has a $4.5 trillion market cap, I think next year they're expected to have just revenues, not earnings, revenues of $300 billion. So how on earth is OpenAI really going to get that $1 trillion? Like, barring putting a printing press in the basement, it seems kind of silly to think that those numbers for here and now today for the market cap creation that they've generated is a little ridiculous.
All right.
Wait, I got one more thing. So when I heard the Broadcom deal this morning, I kind of laughed, and it reminded me of, remember that Oprah episode where it was like, you get a car, and you get a car, and you get a car. I feel like we're in this stage where it's like, you get a partnership, you get a partnership, everyone's getting a partnership. Like, who's next? It's getting crazy out there.
This is more like Shark Tank and semis.
Yeah.
And, where in Shark Tank, the vast preponderance of the deals never get consummated.
Yeah.
So they're just, hey, why not? It's not costing me anything. Sure, I'll be an investor.
But is that a risk for the market? Is that one of the risks that Jimmy was talking about?
It's
a moment we need to pay attention to?
So is it a risk for the market? I don't think the market's reasonably spending on that. I think you've got the real buyers with real business models and balance sheets like Meta, like Microsoft and Google and others that are actually doing something. This is, doing deals and could support the deals. Here you can't. So it's circular financing, and
Right.
I'm not sure that most of it
We got to leave the
comes
conversation there. I think it's hard to tell Broadcom investors that right now. Shares up about 10.5%. All right, coming up, I want to turn to all of you. Joe, starting off with you, the fact that we're seeing a very dovish Philadelphia Fed president, seemingly that the idea that we're not going to get CPI and PPI as expected, not so much of a big deal. Is that a great sign for the market, or is this, again, a market that you previously said doesn't really need these rate cuts, and it isn't that meaningful?
I don't think the market needs the rate cuts. I think if there's a wobble within the market or the labor market, the Fed comes to the rescue. I think the biggest challenge for an investor is if, in fact, you see earnings falter and contract. There's no real response for that.
Can I just ask a clarifying question? Are you saying the market doesn't need the rate cuts, or the economy doesn't need the rate cuts?
The market doesn't need the rate cuts.
Really? So you think if the Fed came out and said, we're not cutting going forward, the market would hold this level?
I think the market would wobble to a certain extent, but I think as long as earnings are strong, I think it would recover.
I think the easiest thing we can all probably agree on is that this month we will get a 25 basis point rate cut. What happens after that depends on too many factors that we just don't know right now. Trade wars, shutdown, et cetera.
All right, a number of factors there. Again, Anna Paulson striking a dovish tone with our Steve Leisman. I want to alert you guys about something coming up tomorrow. We got a big halftime report coming your way tomorrow. Scott Wapner is live from the CIS Alternatives Conference out in Beverly Hills. He's got a big slate of guests lined up across halftime report and closing bell. You want to be sure you watch full coverage. It starts tomorrow at noon Eastern, right here on halftime. Again, Scott's coming back. Big lineup. You're going to see it all tomorrow, not only on halftime, but also on closing bell. And with that, we want to get to our final trades. Jim Lebenthal, might as well start with you. You're first up.
Well, look, if I'm a little nervous, just a little nervous, I'm going to go with something that's kind of on the safe side, AbbVie. Now, this has been an aggressive name this year, up about 30%, still has a good dividend yield, attractive valuation. So regardless of whether I need to be nervous, this is a good pick.
All right, Steve Weiss.
Amazon, look, it's up a little today in the bounce back, but this has really been somewhat of laggard. Not that it hasn't done well, of course it has, but it's lagged the other AI plays, and they're going to do extraordinarily well with AWS. More data, more compute power, more cloud.
Jenny Harrington, you actually mentioned this company earlier.
I did.
Sixth Street Specialty Lending. Give us the thesis why this is a good buy right now.
So there's been a weird phenomenon in the last couple weeks where you see the private equity stocks like KKR and Carlyle really trade down, but the private lenders trade down way more. That relationship should be reversed. This is a very high quality private credit lender, 9.5% yield. I largely agree with Joe that I don't want to touch them, but I'm very comfortable with this particular company, and it's been dragged down more than it should.
Yeah, those shares up about 2.5%. Joe Terranova, you get the last word.
2 years ago, Josh Brown and I were having a dinner on Long Island with a huge fan of the show and a New York sports legend. We discussed this stock, Datadog. I certainly hope he purchased it because it's going to break out further to new highs.
All right, that's going to do it for halftime. We got the exchange starting.
Welcome to Blue Cloud Trading. I'm George. It is Monday. It's 7:01 p.m. Market is closed, and we're going to do a quick review of the markets to see what happened today after the close. You can see the Dow Jones today up 1.29%. Big change in direction of the market since Friday. We had a gap up here. You can see that the price moved up. So we've basically in a nice upward channel here in the Dow. NASDAQ basically broke through this level right here, okay, and continued up 2.21%. That's a pretty big move. S&P 500 also gapped up, basically up 1.56%, and the Russell 2000, okay, you can see that little triangle right there was broken, and it continued up 2.78%, so it was up the most. Let's look at the heat map, guys. Here's the heat map for today. You can see all the stocks in the S&P 500. Nvidia up 2.82, Google up 3.01, Tesla up 5.42, Oracle up 5.14, Broadcom up 9.88. So a lot of the tech stocks did well. Healthcare stocks were a little bit behind. You can see here in the consumer defensives also, they didn't do so well, but pretty much most sectors were up today. If you look at the groups, it was just consumer defensives and healthcare that were down slightly. Okay. For the 1 week performance, it's still utilities at the top. And here's what we're going to do in this video, folks. We're going to cover, all right, the stocks they discussed on the halftime report. Not all of them, but about 18 stocks and ETFs that you see right here on the left. What I've done is reviewed all those stocks actually, and I've highlighted the strongest ones with a blue flag here. These are the strongest, and these look the strongest as far as the Ichimoku indicator is concerned. So we're looking at the technicals here. So let's get started here with the other thing we're going to cover in this video is the Mag 7, some of the Mag 7s like Tesla, Apple, and Meta. We'll also cover the strongest sectors ETFs that I've got listed here with a blue flag. All right, not all of them, just the ones that are looking really strong for today. So let's get started with the Qs first. What we've got here is a bullish harami pattern that has formed. So here was the big down day on Friday, right? After the announcement that a big tariff was going to be imposed on China. And then today things have basically cooled down a little bit, right? So up 2.12%. And there's a higher probability that the Qs here will move up tomorrow based on this pattern alone. And let's look at the weekly chart. Still in a very strong uptrend, okay? Russell 2000, same thing on the weekly. Here's the daily chart, creating a bullish harami as well. Bullish harami is essentially when you got, like I said, this red large candle followed by a smaller bullish candle that's within the body of the prior candle. Get the SPY S&P 500, same thing here, okay? Up 1.53%. It did not close above the Tenkan though, so it does not get the flag right there. And on the weekly chart, it does still look pretty bullish overall. Dow Jones looking very strong still on the weekly chart. On the daily chart, it is looking the weakest actually, even though it was up 1.28% and formed the same exact pattern. It's currently under both of the moving averages right there, as you can see. The VIX, all right, we had that volatility spike on Friday. Now we've got what's called a bearish harami. That's when you have a bullish large candle followed by a small red candle. And so there's a higher likelihood that the VIX will drop. Okay. What about FEZ? That's the Euro Stocks ETF, another bullish harami. Again, let me just show you guys what that bullish harami looks like on the candle pattern reference sheet here. This is what a bullish version looks like right there. And the bearish version right here, large bullish candle followed by the small red candle. Higher probability, okay, trade to the upside after a pullback like this, that this will pop up tomorrow. No guarantees though. Okay, let's take a look at the stocks they talked about and ETFs. We're going to start off with Caterpillar. CAT, very strong uptrend here on the daily chart. It was up 2.74%. The weekly chart also looking really good. CVS was up 0.69%. Here's a weekly chart. It's 3 weeks now above the 200-day, that dotted yellow line. That's the 200-day moving average. And above the cloud, the Ichimoku cloud, above the moving averages, the Tenkan, the Kijun. You've got Chiku span here above price. If you're unfamiliar with Ichimoku, check out my prior video today that I made with, it's Tom Lee's on the cover of that. And I go into depth about how to read the Ichimoku indicator. COR, Sencora Inc. Check this one out, guys. You can see here it basically broke through this little consolidation area right there. Oops. Okay. Let me just fix that a little bit. There we go. So there's the box. It was broken on Friday. The healthcare sector is looking pretty good. The medical distribution industry. And the COR looks good on the weekly chart. Here it is on the daily. JP Morgan. Here's a position that I had a position in this a few times, well, more than a few times this year. And my last one I got out right here when price crossed and closed under the Tenkan right there. Had added back on August 12th, got out on October 1st for 7.2% profit. Now all of a sudden it's looking more and more bullish. All right, now it does. Let me just double check this, because at 4 p.m. the closing price was 307.97. It's just barely above the Tenkan-sen, the green line. The green line conversion line 307.70. So we have crossed it, and on higher volume. I don't like what I'm seeing down below here with the directional movement index, though. Okay, you can see the red line is still above the green line, and the ADX is still moving up. So, I don't know if one day is going to be enough to qualify. Plus, there was a little bit of selling there towards the end of the day. That's represented by that little wick that you see at the top. So if we switch to a 3-minute chart, you can see that it kind of stalled up in these 309 level and dropped down to 307. Goldman Sachs also popped above the 9 period right there, the green line, on higher volume. This one looks a little more bullish with Tenkan-sen above Kijun-sen. I'm sorry, Tenkan-sen above Kijun-sen and the positive DI9 above the negative DI9. That's when the green line is above the red line. So that's bullish too. But the ADX is just moving sideways. Nothing special happening quite yet. I'd probably draw like a trend line maybe from that high and that high right there. Wait for a breakout. That would make more sense to me if you're thinking about taking a trade in this. MTUM, momentum factor. This one's also just now consolidating. You can see the box that's building right here, another box. And so I'd hold off until price breaks above the top of the box. AZN, also pretty bullish, has pulled back. It was down 0.02%, and holding up above the Tenkan-sen. So that's positive. Here's the weekly chart. Still looking good. The rest of these stocks, not so great. As you'll see in a few moments, there will be something wrong with the technicals, meaning the price will either be inside the cloud, under the cloud, or under the moving average. Okay, and so here's AbbVie, for example. And so it's kind of stuck in between the two moving averages. But overall, it's still in a very strong uptrend on the daily chart and on the weekly. ZBH, on the other hand, under the cloud on the weekly chart, under the cloud on the daily. I'd stay out of this one, folks. That was Jenny Harrington's final trade back on July 11th. Wynn Resorts dropped under this 117.86 level. That's based on these prior highs from 2023. You can see those right there. That's not good. So it's inside the Ichimoku cloud now. Did not bounce off of it. So I'd be kind of concerned about that, honestly. Let's take a look at PayPal next. PYPL is the ticker symbol. This one on the daily chart is inside the cloud, under the 200-day. Stay out of that one. Citigroup also pulling back now, finding support at the cloud. We might get a bounce here. The only problem is, as you can see, that the green line has crossed under the red line. That is a negative sign, okay? And so I'd hold off on Citigroup. TSLX on the daily chart. Today was a big day for it. It was up 3.98% on higher volume. Looks like a little bit of that momentum was lost on the downside. You can see the ADX started to drop here and price moved up. The only problem is we are still under the cloud, under the 200, under the Kijun-sen. I'd stay out of that one too. WFC, under the cloud. Stay out of that one, folks. KBE, same thing. That's the bank ETFs. S&P bank ETFs. MLM, this is Martin Marietta Materials, building materials. This one looks pretty good. As you can see on the daily chart, it's moving up. It was up 0.99% today. On the weekly chart, it's also looking pretty bullish. Let's take a look at something. I'm curious to see if it broke above that high right there. It did, in fact, break above it. Now, the high there is 633.23. Let's color that light blue for the weekly chart. And as you can see, yeah, we're basically above it right now. If it can close above that 633.23 by Friday, on Friday, we want to make sure that price is above that level. I think this looks pretty bullish. In fact, I'm going to create a little alert to remind myself about that one. Oh, okay. All right, let's look at ARES, Ares Management LP. Now we've got a little bit of decline here. You can see the slope right there, right? So we've got a lower high from the prior high. we broke through this little level here. We got under the Ichimoku cloud. Stay out of Eris management. All right. Yes, we've got a rising 200, but right now it's to the downside, and so I'd hold off until we see some strength. Then you've got D-Dog. Now this one is interesting because it did in fact break above this prior high. That happened. But let's take a look at that top right about there. The high there is 170.08. Let's color that light blue as well. We're looking at a weekly chart here. That's the target. So that's approximately 3.35% away from where we currently are. Not something I would jump into yet. Okay, there's the price back in from 2024. So if we break above 170.08, okay, that's a different story. It's going to show us strength and more demand for this particular stock. But right now it's getting close to resistance levels. How about Tesla? Well, Tesla was up 5.42%, as you can see here, but technically speaking, it's still declining. We are currently under the 9 period. That's that green line right there. And you can see that we're down downward slope right there. So I'd hold off on Tesla. Apple also dropping. This was on Friday. Here we are today. Not a bullish candle here, even though it was up 0.97%. Negative DI crossing above positive DI. I'm not liking this either. What about Meta? Meta's under the Ichimoku cloud. I'd hold off on this one, on this stock as well. Negative DI is above positive DI. It's still in decline. We've got ourselves that slope right there. It's still dropping. All right, now let's take a look at the sectors. Just the strongest ones, folks. Silver taking off, up 4.03%. SLV is the ETF. If you're interested in having a position in silver, this is a good play right here. It's got 57.6 million shares traded today. Okay, that's a lot. So it's very liquid ETF, and that's important. COPX, Copper Miners ETF, also, on Friday it was looking pretty bearish. You can see that it dropped under the 9 period, and then it recovered very quickly today, up 6.09, regaining its continued uptrend here. We'll see if it can keep going. One thing I will note, if you look at the ADX, which represents momentum, a little of that momentum was lost in this 2-day event here. You can see that if you go straight down here, you'll notice that ADX, where it was moving up, has started to decline here. But price is, it's up quite a bit, 6.09%. So we'll see what happens. Let's take a look at XLK, technology sector ETF. We've got a bullish harami right here, but it is also a doji. It appears to be right above the 9 period moving average, up 2.44%. I'm not too crazy about the fact that the negative DI9 is above positive DI, but overall, the strength of this trend on the weekly chart is still very bullish. All right, so it might be just a short-lived event here. SMH, semiconductors, also recovered after that big drop on Friday, up 4.43%. Utilities, unlike the other sectors like SMH and XLK, I want you guys to check it out. Look at that strength. It did not even come close to the Tenkan-sen here on Friday. Okay, so we still have that nice base right there, and it looks like it's building a nice base. If it can get above these highs right here, I think it's going to obviously continue to expand. The ADX is still looking pretty strong, right? It's still moving up. That's good. That's a daily chart, and if we look at the weekly chart, also looking very strong here too. GLD, look at GLD gold ETF moving up 2.43% on the weekly chart. Here it is on the daily. Similar to utilities, gold also pulled back a little bit. This was Thursday. It dropped on Friday. It was actually pretty strong, which is interesting. It created, remember, a bullish harami. Again, this is the pattern that we're talking about right here. And when it's close to the Tenkan-sen, that's even more bullish in my opinion. And so, yeah, it actually gapped up. So it was up 2.43% by the end of the day. GDXJ is the Junior Gold Miners ETF. This one was under the Tenkan-sen for 2 days, but gapped up And it looks to me like it got above the high of 105.24. No, it did not. I take that back. So this is a level that I'd be watching. 105.24, that's the high of this candle right here. If it can get above that, because it closed at 105.14 and closes above that, that's very bullish for the junior gold miners. Everything else looking pretty bearish. I'll just run through it so you can see what I'm talking about. Oil K, this is the K1 free crude oil strategy ETF. Here's communication services still dropping. Well, we did get a bullish harami, but look at that negative crossover there. Bitcoin finding some support of the cloud, but under the moving averages. Real estate still dropping. We get a bullish harami right there too. XLY, another bullish harami here. Looks like it might bounce off the cloud, but it's still under the moving averages. Healthcare under the Tenkan-sen today. This is the XLV ETF. So it doesn't really represent the entire healthcare sector. Just keep that in mind. When I do my analysis on the weekend videos, I go into a more broad, analysis of the sectors. Okay, XLV is a very, very small, portion of the stocks within the healthcare sector. XLP still, like I said before, consumer staples, hasn't been doing well. Industrials, XLI, we got a bullish harami. It did, you can see here on Friday, it entered the Ichimoku cloud. Today, Monday, it popped right back above. It's, there's a good chance it might pop above these moving averages. Problem is, a little bit of damage has been done here. All right, so there was a lot of selling that took place. So the question is, are people going to be skeptical about getting back in, going into the rest of the week? Today is one thing. Can we see a continuation? XLF inside the cloud, still inside the cloud. This is the financials ETF, XLF. So it doesn't look super bullish here yet. Energy, another bullish harami, under the cloud though. XHB, under the cloud, above the 200-day, but looking pretty bearish still. That's the home builders ETF. Materials, we get a bullish harami here, under the cloud. This is just the XLB ETF. And that is going to do it for this video. Just a quick reminder that I did do a video earlier today. You might want to check it out. Tom Lee is in that one. And I also did a members only video this morning. So I was a busy person today. So definitely check these out, guys. This one here I posted 8 hours ago. This video here 6 hours ago. Wow, 3 videos in a day. That's not usual for me. And I've got allergies. So hit the like and subscribe button and subscribe. Maybe share this video with someone. Hit the join button if you want to see this members only video that goes over my entire portfolio that I went, into all the stocks. And to do that, you just click on this link here, or you can hit the join button right on YouTube. If you hit the join button, select Blue Cloud Trader, and then hit the join button again, and you'll be able to access those member only videos. You'll also, if you go upgrade to the Blue Cloud Legend level, select this one to start with, you'll also get those member videos plus the daily trade updates of the trades that I placed earlier today. So I do share those before the market closes with the members. What stocks did I add? What stocks did I close out of? You can get that information. There'll be a new tab that pops up over here next to the posts, and it will look like this right here. You'll see a membership tab. Okay, that's what you'll look for, and that's what you'll find, and basically that's where you can find the information. If you guys want to learn a little bit more about the software that I use and all that other stuff, click on right here where it says 9 more links and scroll down. There's a whole bunch of links here for different things. Check that stuff out too. Okay, have a great rest of the night. Thanks for watching. Catch you in the next one, guys.